You cannot put AI in the kill chain. You cannot let AI be part of the decision-making process. If you want it analytically as an adjunct, okay, it has a role. But AI will fail catastrophically at that because it lacks a lot of qualities that humans have. Empathy, sympathy, common sense, intuition. You cannot program any of those things. And it's not like, oh, gee, give Silicon Valley time, they'll catch up. No, it's non-programmable. You can program deductive logic, which we got from Aristotle. You can program inductive logic, which we got from David Hume and others. But you cannot program what's called abductive logic, and you have to read Charles Sanders Peirce to really understand what that is. But I give two examples of how World War III, a nuclear war that would have ended life on Earth, came very close to happening in the 1980s. And in both cases, one, a Soviet lieutenant colonel, Russia basically, and then another one, a United States lieutenant general, disobeyed orders to de-escalate and stop the war. But that's the point. They disobeyed orders, and the Russian was actually reprimanded. If they had followed orders, they would have reported to their superiors, and we probably would have gone to World War III. But the point is, AI would have followed orders. AI would have escalated the conflict and led to the end of life on Earth.
What if the next financial crisis doesn't begin with a bank failure? What if it begins with a trade most Americans have never heard of? James Rickards says the unwinding of a yen carry trade could become an economic earthquake, triggering asset sales, higher U.S. interest rates, and potentially a chain reaction across global markets. But that's only one part of his warning. He also argues that AI could create a completely different kind of systemic risk, one that reaches from Wall Street to national security. And his most extreme warning? Never put AI inside the nuclear decision-making chain.
You say, well, what could go wrong? Well, the first thing that could go wrong, and the biggest thing, would be if Japanese interest rates went up. Well, for the first time in 30 years, they are going up. They're up. They're not sky high, but they're up to, in that intermediate term, they're up to about 2.5% now. So what that does, it takes the spread between the 6 or 7% where you could invest and the 0%, borrow rather, and the 0% we used to borrow, and it starts to compress that spread. That spread gets smaller, the returns get smaller, and at some point it becomes relatively unattractive, given the fact that there are other risks. There are exchange rate risks, for example, we haven't talked about, but because you're short yen, long dollars, that's a separate discussion. But that interest rate differential goes away, starts to go away. Your return on investment starts to go down. And as the one who borrowed in yen, you look at it and say, first of all, maybe it's time to get out of it, because if this keeps going, a lot of other people are going to get out of it. And you don't want to be the last one to run out of a burning theater, so to speak. And so one way to do that would be to borrow in euros or dollars, swap it into yen, and pay back the yen loan. That's the most straightforward way. But that presupposes that you have the borrowing capacity in dollars or euros. Maybe you do, but maybe you don't. Maybe the banks are saying, they've tightened up lending standards. They're saying, no soup for you. We're not going to give you a loan today, or at least not on very attractive terms. So then what do? Well, you sell assets. At that point, you're unwinding your own balance sheet. You're getting out of the yen carry trade, but you're not doing it with new dollar borrowings. You're doing it by selling the assets themselves. That feeds on itself. That can cause a stock market crash. It can certainly, I'm not saying there's direct linkage, although there certainly could be, between the private credit meltdown that we've seen in recent months, really since the start of this year. And it can feed on itself. It can snowball very easily, and the entire system can collapse.
The important point here isn't whether Rickards' worst-case scenario happens exactly as described. The important point is the mechanism he's warning about. A trade that looks profitable while borrowing costs stay low can become dangerous when rates move, leverage unwinds, and investors are forced to sell assets at the same time. And that's why he calls the unwind an economic earthquake. The next question is even bigger. What happens when Japan itself becomes part of the pressure on U.S. interest rates?
How do you strengthen the yen? Well, you sell dollars and buy yen. Where is Japan getting the dollars? What they're starting to do is sell U.S. Treasuries. Japan is the largest single holder of U.S. Treasury securities. Used to be China until fairly recently. Japan passed them. Japan is now the number one holder of U.S. Treasuries. What happens when Japan starts selling Treasuries to get dollars to prop up the yen? U.S. interest rates start to go up. So the web of connections here between exchange rates, interest rates, sovereign bonds, securities markets, leverage finance, it's very densely connected. So you not only have the potential for asset sales and asset price meltdown that we talked about, but you also have the potential for much higher U.S. interest rates if Japan has to sell treasuries. Well, we've got an election coming up in 3 months. I think with this mail-in early voting, they're going to start voting in about a month at this rate. And the Trump administration is desperate to keep. They would love to get lower prices for gas at the pump. That's an ongoing battle, but they definitely want lower interest rates because that feeds into the home mortgage market and affordability and everything else. So what Bessent has done in conjunction with the Fed, the Federal Reserve acts as what's called fiscal agent of the U.S. Treasury in these deals. They've organized tens of billions of dollars of swap lines with Japan where we can lend them dollars and they can just give us yen, and we just kind of sit on the yen for an indefinite period of time, or just extend lines of credit in effect from central bank to central bank, giving the Bank of Japan the dollars they need to prop up the yen so they don't have to sell treasuries so we don't get higher interest rates. So hopefully that's a clear explanation, but it makes 2 points. Number one, that's what Bessent's doing right now. He's throwing Japan a dollar lifeline so they don't have to sell treasuries so our interest rates don't go up. But as I mentioned, the very dense web of connections from interest rates, spreads, exchange rates, sovereign security, basically reserve positions and U.S. Treasury securities, and leverage markets as a whole is astounding. But it has the makings of a meltdown that I would say doesn't necessarily look like 2008. It looks more like 1998.
This is where the story gets much more relevant to ordinary Americans. The warning isn't simply about Japan. It's about how interconnected the global financial system has become. Currency markets affect bond markets. Bond markets affect interest rates. Interest rates affect mortgages, credit, and asset prices. Rickards' argument is essentially that something happening thousands of miles away can eventually show up in an American household's borrowing costs. And then the interview moves from financial markets to something far more politically explosive.
The whole war was a mistake from the start, and anyone who thought you could start a war with Iran and not end up with the Strait of Hormuz closed doesn't know anything about history or strategy or geopolitics. The idea that there would be a rapid regime change in Iran was always nonsense. I mean, that was the same thing that led to the war in Ukraine. Victoria Nuland and all these warmongers in Washington. I would include Lindsey Graham and others. Passed away sadly. That the war in Ukraine was never about Ukraine. It was about destabilizing Russia, and the idea was that if you provoked Russia into doing what they eventually did, which was the special military operation, that would destroy the Russian economy. Remember Biden saying, the ruble is rubble, and the sanctions will strangle the Russian economy. And John McCain used to say it was a gas station masquerading as a country, et cetera, et cetera. That was all nonsense, but I said it was nonsense at the time, as did other analysts. The ruble's about where it was before the war began. I mean, it dipped a little bit in the immediate aftermath, but then it recovered. It's been very stable ever since. The Russian economy is outperforming the U.S. economy. The biggest economic problem in Russia right now are labor shortages because they put the economy on a full war mobilization. These sanctions have failed. They're between China picking up the slack from Europe and ghost fleet of tankers, et cetera. Russia's doing fine, and Putin's more popular than ever, and he's up for election. He's going to win. So that whole premise was nonsense. Now over to Iran. What did we hear? This is going back to February, when the end of February, when the war started. The Iranian people are going to rise up. We should supply them with weapons. They're going to overthrow the Ayatollah. There'll be regime change. We'll get the highly enriched uranium. It'll be over. And Trump originally said a couple of weeks, and he's trying to say a couple of days. Again, all nonsense. There has been no regime change. We've killed a lot of leaders. We killed 40 top religious, military, and political leaders on the first day, but they just replaced them. Then we killed 40 more, and they replaced them. Killing leaders isn't regime change, it's leadership change, but that's not regime change.
This is one of the most controversial parts of the interview, so don't soften it in the edit, but don't present it as established fact either. This is Rickards' assessment of the war and its objectives. What makes the argument especially interesting is that he doesn't stop at regime change. He argues that the real danger could be the economic consequences of a prolonged disruption around the Strait of Hormuz, because that would affect oil and critical industrial inputs. That's where the geopolitical story turns into an economic story.
Having said that, I would forecast gold to be at $10,000 an ounce in the not too distant future, whether that's mid-2027, late 2027, but sooner than later. And when I say that, people go, wait a second, Jim, that's crazy, But what they don't realize is that as gold goes up, now here we're in another behavioral bias. It's called anchoring. We tend to anchor on a number, which gives it a comfort level. So let's just take $1,000 an ounce increase, and you own 50 ounces, let's say. So if gold goes from $2,000 to $3,000 an ounce, you just made $50,000, 50 times 1,000. And if it goes from $3,000 an ounce to $4,000 an ounce, you made another $50,000. So people anchor on the $1,000 and the $50,000 in that step-like pattern. But what they don't realize, at least not right away, is that each $1,000 increment is easier than the one before, because you're working off a higher base, so it's a smaller percentage gain, even though it's the same $1,000 gain. So by anchoring on the 1,000, so when you go from $3,000 to $4,000 an ounce, that's a 33% increase. That's a heavy lift. But when you go from $4,000 to $5,000 an ounce, that's a 25% increase. That's easier. Now, when you go from 9,000 to 10,000, that's only an 11% increase, which is like a week's volatility these days. So my point is, gold's gonna, it's gonna chug back, a little engine that could get back to $5,000, make its way to $6,000. But it's going to go 7, 8, 9, 10 really fast, much faster than people expect.
Now we get the number most viewers will remember. Rickards isn't merely saying he's bullish on gold. He's putting a specific target and time frame on the table. $10,000 an ounce. That's his forecast, not a guaranteed outcome. His reasoning is based on historical price cycles, behavioral psychology, and the idea that percentage increases become easier as the underlying price rises. Whether that forecast proves right or wrong, it's exactly the kind of claim that creates curiosity. What would have to happen for gold to reach $10,000?
There are very serious risks, and in my view, the risks are being underplayed or ignored by the tech bros and others with self-interest. Either they're lined up for $1 trillion IPO or whatever, mostly the IPO money, I guess. So they don't want to talk about the problems. But I have spoken to some of the top people in the field. Off the record, one guy said 1 foot in the CIA and 1 foot in Silicon Valley. He's probably one of the most knowledgeable people around. He said to me, Jim, he said, what we see is problematic. What's behind the curtain, you can't even imagine. They're afraid to release it because they know it has no governors, no controls, and it'll spin out of control. That conversation was over a year ago. Well, since then, some of those releases have taken place, and we've seen they use the word sandbox. My technology is in a sandbox. That means it's not connected to the internet. Whatever happens, it could mess up, but it can't go anywhere else. What we're seeing now is these programs are so sophisticated, they're jumping out of the sandbox, penetrating the internet on their own, attacking other systems, mining data, all with no governors at all, no controls at all. So what are some of the specific dangers? One is something called the fallacy of composition, which actually John Maynard Keynes articulated in the 1920s, 1930s. And what he said is that things that work at a certain scale, work well at a certain scale, will fail catastrophically at a larger scale. And a very simple example, you're at a baseball game, and the person in front of you is tall and they got a big hat and you can't really see very well. So you stand up. Well, that works. You can actually see perfectly. But what happens next? Well, the person behind you stands up and the person behind her stands up, and next thing you know, everyone's on their feet. Everyone has the same relative view, but everybody's worse off because you all stood up. Well, it's that the same is true in finance, particularly with passive investing. So let's say there's a financial panic or meltdown of some significance. What's the best individual strategy? Well, the best individual strategy is sell your stock, sell a lot, if not everything, sell a lot, go to cash, take a beat, wait till the bottom hits, and then when you're sure it's the bottom, come back in at bargain basement prices. That's a really good strategy. But what happens if everybody does it? You have all sellers, no buyers, no bottom, you blow through the circuit breakers, you shut the markets, and it's not clear when they're going to reopen. That is a catastrophic failure.
This is the financial version of the AI warning from our opening. The concern isn't simply that an AI model could make one bad investment decision. The deeper concern is everyone making the same decision at the same time. If automated systems become increasingly similar, a market shock could theoretically produce synchronized behavior, creating sellers everywhere and buyers nowhere. That's the systemic risk argument Rickards is making.
But I give two examples of how World War III, a nuclear war that would have ended life on Earth, came very close to happening in the 1980s. And in both cases, one, a Soviet lieutenant colonel, Russia basically, and then another one, a United States lieutenant general, disobeyed orders to de-escalate and stop the war. But that's the point. They disobeyed orders, and the Russian was actually reprimanded. If they had followed orders, they would have reported to their superiors, and we probably would have gone to World War III. But the point is, AI would have followed orders. AI would have escalated the conflict and led to the end of life on Earth.
The warning running through this entire conversation is bigger than gold, Iran, Japan, or artificial intelligence. It's about systems becoming so interconnected that one failure can spread far beyond where it started. A currency trade can affect global markets. A treasury market problem can affect U.S. interest rates. A geopolitical conflict can affect energy prices. And AI can potentially amplify decisions across financial and military systems at speed humans may struggle to control. Rickards' answer isn't that every one of these disasters is inevitable. His argument is that investors, policymakers, and technology companies should understand the possibility before the system is under stress. Because when everyone discovers the weakness at the same time, it may already be too late to react.